Chapter 1. The Buffett Philosophy. Warren Buffett, often referred to as the Oracle of Omaha, is a legend in the world of investing. His approach? Simple yet profoundly effective. Unlike many who chase after the latest trend, Buffett sticks to investments he understands deeply, focusing on long-term value rather than short-term gains. This might surprise you, but despite the allure of real estate, Buffett seldom positions it at the top of his list. Why, you ask? It boils down to his investment philosophy. Buffett is all about buying businesses, not just assets. He prefers stocks, seeing them as owning a piece of a business, offering both control and transparency, which real estate investments often lack. Interestingly, Buffett's wisdom doesn't stop there. He emphasizes the importance of patience, comparing investing to a game of baseball where you can wait for the perfect pitch. In real estate, the market doesn't always offer such perfect pitches. Buffett also talks about the circle of competence, sticking to investments within his knowledge realm. Real estate, with its myriad complexities, doesn't always fit into this circle for everyone. Remember, it's not about the quantity of your investments but the quality. And for Buffett, that often means looking beyond real estate. Chapter 2. Real estate versus stock market. Now, let's pit real estate against Buffett's preferred playground, the stock market. Many view real estate as a safe harbor, tangible and less volatile. However, Buffett's track record in the stock market challenges this notion. He argues that stocks, with their liquidity and diversity, offer opportunities real estate can't match. Consider this. The stock market allows investors to buy into companies that own and manage vast real estate portfolios, often with more flexibility and less hassle than direct property ownership. Buffett, through Berkshire Hathaway, invests in such companies, leveraging the real estate market indirectly, but with all the benefits of stock investments. Moreover, Buffett highlights a crucial advantage of stocks: the ability to invest in a variety of industries. Real estate, by its very nature, is more restrictive. You're putting a lot of eggs in one basket, which can be risky. Then there's liquidity. In times of need, selling a property can be a slow and uncertain process, whereas stocks can be liquidated almost instantly. For Buffett, the ability to move quickly is invaluable, not just for seizing new opportunities but also for navigating financial downturns. In essence, while real estate has its place, Buffett's preference for the stock market is clear. It's not just about growth, it's about smart, flexible, and informed investing. Stocks, in Buffett's view, often present a clearer path to achieving these goals than real estate. Chapter 3. The Myth of Tangible Assets. A common belief among investors is that tangible assets, like real estate, are safer investments. After all, there's something reassuring about owning a physical piece of property. However, Warren Buffett challenges this notion, arguing that the true safety of an investment lies not in its tangibility but in its value proposition and the owner's understanding of the business. Buffett believes in the intrinsic value of investments, which is the present value of an asset's future cash flows. According to him, many people overestimate the safety of real estate due to its physical presence, overlooking factors such as market fluctuations, property management challenges, and the impact of economic downturns. In contrast, stocks can represent companies with solid fundamentals, predictable cash flows, and the ability to adapt and grow over time, regardless of their intangible nature. Furthermore, Buffett often points out that an investment's liquidity and the ability to value it accurately are more critical to its safety than the fact that you can touch it. He highlights instances where real estate markets have crashed, reminding investors that no asset is immune to loss. By focusing on understanding the businesses behind stocks and their intrinsic value, investors can often find safer and more profitable opportunities than in the real estate market. Chapter 4. Liquidity Concerns. One of the most significant advantages of stock investments over real estate, according to Warren Buffett, is liquidity. Liquidity refers to how quickly and without significant loss in value an investment can be converted into cash. This is where real estate often falls short. Buffett has emphasized the importance of being able to react swiftly to market changes or personal financial needs. Real estate, with its long selling process and the potential for market stagnation, cannot offer this level of liquidity. In contrast, stocks can be bought or sold almost instantly during market hours, providing investors with the flexibility to adjust their portfolio in response to new information or financial requirements. Moreover, the illiquidity of real estate can become a critical issue during economic downturns when property values can plummet and sellers outnumber buyers. In such situations, property owners might find themselves unable to sell at any reasonable price, facing significant losses or being forced into unfavorable sales. Buffett warns that this lack of liquidity can not only impact financial outcomes but also limit investors' ability to pursue other opportunities that may arise. Buffett's approach encourages investors to consider liquidity as a paramount factor in their investment decisions. He advocates for a portfolio that allows for quick and efficient adjustments, ensuring that investors are never in a position where they are forced to sell at a loss or miss out on potential gains due to their investments being tied up in hard-to-sell assets. Chapter 5. Management and Maintenance Hassles. Warren Buffett's investment strategy is marked by its pursuit of simplicity and efficiency. Real estate, with its inherent management and maintenance demands, often contradicts this approach. Buffett has always been keen on investments that deliver returns without the constant need for his intervention. Here's where real estate often loses its appeal for investors like him. The truth is, owning property isn't just about collecting rent checks. It involves dealing with tenants, maintenance issues, and the ever-present risk of vacancies. These factors not only consume time but can also erode the investment's returns. Buffett, who values investments that are both profitable and low maintenance, sees these obligations as unnecessary complications. Furthermore, the real estate market's susceptibility to local economic changes can add another layer of unpredictability to the investment. A downturn in the local economy can lead to vacancies and falling rental incomes, requiring even more hands-on involvement and potentially leading to cash flow issues. In contrast, stock investments in well-chosen companies can offer passive income through dividends, without the direct involvement required in real estate. Stocks allow investors to benefit from the company's growth in the broader market's upward trends, often without the day-to-day hassles associated with property management. Chapter 6. Market Efficiency and Real Estate. Warren Buffett is a strong proponent of investing in efficient markets, where information is quickly reflected in stock prices, allowing for rational investment decisions. The real estate market, by contrast, is often characterized by information asymmetry, where buyers and sellers have varying levels of access to relevant data, leading to inefficiencies. These inefficiencies can manifest in prolonged periods for transactions to complete, pricing disparities, and a higher potential for emotion-driven decision-making. Real estate markets are also more segmented and localized, which can result in significant differences in market performance, even within the same city. This variability can complicate the investment analysis and decision-making process, making it harder to identify undervalued opportunities. Buffett has often pointed out that the stock market, while not perfect, offers a level of transparency and efficiency that is hard to find in real estate. The ability to quickly analyze and act on information, combined with the liquidity of stocks, provides a fertile ground for disciplined investors to make informed decisions. Moreover, the stock market's efficiency enables a more straightforward valuation process, using metrics like price-to-earnings ratios, which can help investors identify undervalued stocks. In real estate, however, the valuation process is often more subjective, relying on factors such as location, condition, and market demand, which can be more challenging to quantify accurately. Chapter 7. The Role of Leverage. Warren Buffett has always approached leverage with a level of caution that might surprise many investors. Leverage, or the use of borrowed money to amplify investment outcomes, is a common practice in real estate investing. However, Buffett's views on leverage provide a stark contrast to the real estate investor's playbook. He famously quipped, "When you combine ignorance and leverage, you get some pretty interesting results," highlighting the potential dangers of leveraging investments without a solid understanding of the risks involved. Buffett's cautionary stance stems from his emphasis on long-term stability and sustainable growth, values that are often at odds with the high-risk, high-reward nature of leveraged investments. In real estate, while leverage can magnify returns, it also amplifies losses, especially during downturns, making it a double-edged sword. Buffett's investment philosophy leans towards achieving returns through sound business practices and intrinsic business value growth, rather than through financial engineering. Moreover, the Oracle of Omaha highlights the importance of a buffer against uncertainty, which excessive leverage can erode. He advocates for maintaining a strong cash reserve and a manageable debt level, ensuring that investments can weather economic downturns without the need for distress selling or refinancing under unfavorable conditions. Chapter 8. Tax Implications. Taxes play a significant role in investment decisions, and real estate is often touted for its tax advantages, such as deductions for mortgage interest and depreciation. However, Warren Buffett's investment strategy transcends the allure of tax benefits, focusing instead on the fundamental qualities of an investment. Buffett has pointed out that while tax strategies can enhance returns, they should not be the primary driver of investment decisions. He argues that a good investment should stand on its own merits, without relying heavily on tax benefits. This perspective is evident in his approach to stocks, where the focus is on companies' earning power and growth potential, rather than on tax advantages. Interestingly, Buffett's company, Berkshire Hathaway, is known for its minimal dividend payout policy, a strategy that effectively defers taxes on earnings growth, allowing investments to compound at a pre-tax rate. This approach mirrors the tax efficiency often sought in real estate investments but achieves it through the stock market, highlighting Buffett's skill in navigating tax implications without compromising his investment principles. Furthermore, Buffett emphasizes the importance of understanding the tax implications of any investment, advising investors to factor in the after-tax return, which ultimately contributes to net wealth. This level of scrutiny ensures that investors are not swayed by superficial tax advantages but are focused on the long-term growth and stability of their investments. Chapter 9. Diversification Challenges. Diversification is a cornerstone of Warren Buffett's investment strategy, but when it comes to real estate, achieving effective diversification can be particularly challenging. Buffett's approach to diversification goes beyond simply spreading investments across different assets. It's about allocating capital to various ventures that offer uncorrelated returns, thereby minimizing risk while maximizing potential returns. Real estate, however, often requires significant capital outlays for each property, which can limit an investor's ability to spread their risk across different asset types or geographic locations. Buffett has often criticized the notion of diversification for diversification's sake, arguing that it's more prudent to invest in a handful of companies that you understand well than to spread your investments too thin. However, in real estate, this philosophy can be difficult to apply due to the market's inherent local nature and the substantial investment required for each property, making it harder to achieve meaningful diversification without substantial capital. Moreover, real estate investments are often subject to similar market forces and economic conditions, such as interest rate changes or local economic downturns, which can simultaneously affect all properties in a portfolio. In contrast, Buffett's portfolio at Berkshire Hathaway demonstrates a wide range of investments across various sectors and industries, illustrating a diversification strategy that is both deliberate and strategic, aimed at reducing risk while seeking out value. Chapter 10. The Future of Investing. Warren Buffett's insights into the future of investing emphasize adaptability, continuous learning, and the importance of sticking to one's investment principles. Despite his cautious stance on real estate, Buffett acknowledges that the landscape of investing is constantly evolving, and staying informed about changes in market dynamics and investment opportunities is crucial. Buffett believes that regardless of market conditions, the principles of value investing, focusing on companies with strong fundamentals and understanding the intrinsic value of an investment, will remain relevant. He suggests that the investors who will succeed in the future are those who remain curious, adaptable, and disciplined, not swayed by market trends or speculative bubbles. Furthermore, Buffett highlights the growing impact of technology and innovation on investments and the economy. He encourages investors to consider how technological advancements could affect industries and investments over the long term, including real estate. For example, the rise of remote work could have significant implications for commercial real estate markets. In closing, Buffett's advice to future investors is to maintain a long-term perspective, focusing on investments that offer solid fundamentals and enduring value. He stresses the importance of ethical investing and choosing investments that not only promise good returns but also contribute positively to society.